one way to think about it is just kind of basic math. Like if you just look at the numbers, if you were able to improve by 1% each day for an entire year, and those gains compound, you would end up 37 times better at the end of the year. And if you were to get 1% worse, you would whittle yourself almost all the way down to zero.
Have you ever thought about how tiny steps can lead to huge progress over time? That's exactly what the 1% rule is all about. It's about the power of small, consistent improvements. Imagine just giving a tiny bit more effort each day, like 1%. Sounds doable, right? Think about how that little bit extra, added up over days, weeks, and months, can lead to massive financial growth. It's like planting a small seed and watching it grow into a big, strong tree. And in this video, we are going to discuss this 1% rule, a simple concept that can lead to huge financial growth. We'll break down how making tiny, consistent improvements can compound over time, turning small efforts into big results. Whether it's saving a bit more money, investing a little smarter, or finding ways to increase your income, the 1% rule can be your secret weapon for financial success. So, before we get started, if you're new here, don't forget to subscribe and hit the bell icon so you won't miss out on the valuable insights we share in our future videos. Alright, so what exactly is the 1% rule? To understand this, let's take an example. Let's suppose if you improve by just 1% every day, in what seems like no time, you'll have made a huge difference. It's about those little tweaks in your daily routine, the kind that don't seem like much on their own, but are game changers when stacked together. Imagine it's like laying bricks. Rome wasn't built in a day, but they were laying bricks every hour. Now, let's talk about the power of compounding. Think of compounding as the snowball effect. You start with a tiny snowball. That's your 1% improvement. As it rolls down the hill, it picks up more snow, growing bigger and bigger. Before you know it, your small efforts have snowballed into something massive. That's the power of compounding. Small, consistent actions building up to create a significant impact. And the best part? It applies to just about anything. Your skills, habits, health, you name it. Alright, we've covered how small improvements can make a big difference. Now, let's talk about how to use the 1% rule in a practical way, especially when it comes to investing. When you're looking at a property, the 1% rule helps you figure out if it's a good investment. The idea is that the monthly rent you get from the property should be at least 1% of the purchase price. For example, let's look at Joe. Joe buys a house for $100,000. He believes he can rent it out for $1,000 per month. This means Joe is hitting the 1% rule perfectly, because $1,000 in rent is exactly 1% of the $100,000 purchase price. This simple calculation helps Joe see that this property could be a good investment. But there's more to consider. Joe decides to rent out the house by the room, which boosts his cash flow dramatically. This strategy can really help increase your returns. Additionally, the market Joe is in allows him to buy a small multifamily property for a relatively low price. This kind of market condition is ideal for using the 1% rule. So, what should you do? Start by looking at properties and investment opportunities and applying the 1% rule. If a property costs $200,000, you should aim to get at least $2,000 in monthly rent. This quick check can save you a lot of time and help you focus on the best opportunities. Now that we've explored how to use the 1% rule, let's take a look at some of the benefits of this powerful strategy. First up, the 1% rule makes evaluating investment opportunities and rental properties incredibly easy. You don't need to be a math whiz or have a finance degree to use it. Just a basic understanding of the rule can help you make smarter investment decisions. The 1% rule cuts through the complexity and gives you a clear, simple benchmark. For example, if you're looking at a property priced at $150,000, you know you should aim for at least $1,500 in monthly rent. This quick calculation helps you see if the property has potential without diving into detailed financial analysis. Next is profitability. The 1% rule provides a reliable benchmark to gauge whether a property will generate enough income to be a sound investment. It's like having a quick litmus test to see if the property is worth further consideration. For instance, if you find a property that doesn't meet the 1% rule, you might reconsider investing in it or look for ways to increase its rental income. On the other hand, if a property does meet the 1% rule, you can be more confident that it will generate the cash flow needed to cover expenses and potentially provide a good return on your investment. Another great benefit is that the 1% rule saves you time. Instead of getting bogged down with tons of calculations and financial projections, you can quickly filter out properties that don't meet the basic criteria. This allows you to focus your time and energy on the most promising opportunities. The 1% rule is also flexible. While it's a great starting point, you can adjust it based on your investment goals and market conditions. For instance, in some high-demand markets, you might aim for a lower percentage if you know the property has strong appreciation potential. Conversely, in lower demand areas, you might look for properties that exceed the 1% rule to ensure a higher cash flow. Finally, the 1% rule helps manage risk. By ensuring that the rent covers a significant portion of the purchase price, you create a buffer against unexpected expenses or market downturns. This can make your investment more resilient and give you peace of mind. So, to sum it up, the 1% rule is simple. Provides a clear guideline for profitability, saves you time, offers flexibility, and helps manage risk. It's a valuable tool in any investor's toolkit. Alright, we've covered the benefits of the 1% rule, but it's important to also look at its limitations and considerations. It is necessary that you keep these limitations in mind when using the 1% rule. First, market variability. The 1% rule doesn't apply equally in all markets. In high-cost areas, achieving 1% rental income or return on investment might be unrealistic. For example, in cities where property prices are extremely high, like New York or San Francisco, the rental income might not reach 1% of the purchase price. This doesn't mean these properties aren't good investments, but it does mean you need to adjust your expectations and maybe look at other factors like long-term appreciation or the strength of the rental market. Next is additional costs. The 1% rule is a great starting point, but it's not the whole picture. You also need to factor in other expenses like operating costs, property taxes, insurance, and maintenance. For instance, if you buy a property for $100,000 and rent it out for $1,000 a month, you're hitting the 1% rule. But if the property requires a lot of maintenance or has high property taxes, your actual profit might be much lower. You should always do a detailed financial analysis beyond the 1% rule. This means calculating your net operating income, cash flow, and potential return on investment. Look at the full picture to ensure you're making a sound financial decision. Finally, consider your long-term strategy. The 1% rule helps you make quick evaluations, but your investment success depends on many factors. Think about your goals, whether you're looking for quick cash flow or long-term growth, and how this property fits into your overall investment plan. So, while the 1% rule is a valuable tool, remember to account for market variability, additional costs, and do a thorough financial analysis. This way, you can make informed decisions and maximize your financial growth. Now that we've looked at the limitations of the 1% rule, next, it's important to know about how to enhance your financial strategy using this rule. So, let's talk about how you can enhance your financial strategy with the 1% rule. First, consider combining the 1% rule with other financial metrics. The 1% rule is a great starting point, but for a more comprehensive assessment, you should also look at metrics like cash flow analysis and net operating income. For example, once you find a property that meets the 1% rule, dig a little deeper. Calculate your expected cash flow by subtracting all your expenses, like mortgage payments, property taxes, insurance, maintenance, and management fees from your rental income. This will give you a clearer picture of how much profit you'll actually make each month. Similarly, look at the net operating income. This is your rental income minus operating expenses, excluding mortgage payments. NOI gives you an idea of the property's profitability before financing costs. By combining these metrics, you can get a well-rounded view of the investment's potential. Next, let's emphasize the role of the 1% rule in long-term financial planning. Using the 1% rule as part of a broader investment strategy can help you achieve sustainable financial growth. Imagine you're planning for retirement or aiming to build a portfolio of properties. The 1% rule helps you quickly identify properties that are likely to be profitable. But it's important to think long-term. Consider factors like property appreciation, market trends, and your overall financial goals. For instance, if you're investing in an area that's expected to grow, the the property value might increase significantly over time. This appreciation can boost your overall return on investment. Additionally, by regularly reviewing and adjusting your portfolio, you can ensure that your investments align with your long-term financial goals. Another important aspect is diversification. Don't rely solely on the 1% rule for all your investments. Diversify your portfolio by considering different types of properties and investment strategies. This reduces risk and increases the potential for steady growth. Stay updated with market trends and continually educate yourself. The real estate market can change, and what works today might not work tomorrow. By staying informed and adapting your strategies, you can maximize your investment success. Finally, consider seeking professional advice. Financial advisors, real estate agents, and investment experts can provide valuable insights and help you make informed decisions. They can offer a different perspective and suggest strategies you might not have considered. So, to sum up, enhance your financial strategy by combining the 1% rule with other metrics, planning for the long term, diversifying your portfolio, staying informed, and seeking professional advice. These steps will help you create a robust, sustainable investment strategy that leverages the power of small, consistent improvements. And there you have it. The 1% rule is a simple yet powerful tool that can help you make smarter financial decisions and achieve massive growth over time. By combining this rule with other metrics, planning for the long term, diversifying your investments, staying informed, and seeking professional advice, you can build a strong, sustainable financial strategy. Remember, it's all about those small, consistent improvements that add up to big results. Start applying the 1% rule today, and watch how it transforms your financial future. If you found this video helpful, don't forget to subscribe and hit the bell icon so you never miss out upcoming videos. Thank you for watching, and we'll see you in the next video.